Welcome to the Deep Dive. Today, we're digging into the Q3 2025 earnings call for BankUnited. That's ticker BKU.
And this call from October 22nd was a really interesting one.
Yeah, not just for the numbers, but you also had a transition in the C-suite. It was Leslie Lunak's final call as CFO.
Right, with Jim Mackey stepping in. But that's really just the backdrop. I think our mission here is to figure out the market psychology.
What do you mean?
Well, you had this revenue miss, which on the surface looks bad.
Yeah.
But then the stock rips higher on huge volume.
Okay, so the mission is to unpack that reversal. Why did the profitability story just completely overshadow the top line number?
Exactly. Let's get into it.
All right, so let's start with those headline financials. BKU delivered a GAAP EPS, earnings per share of 95 cents.
Which was a clear beat. I mean, that's about 6 or 7 cents above what the street was looking for.
And year over year, that's a 17% jump in EPS. Pretty strong.
Very strong. But here's the catch, the thing that caused that initial confusion. Revenue came in at about $275.7 million.
Which was a miss. It was short of consensus by, what, $4 to $7 million?
Yep. And that's why the stock opened down.
Yeah.
It dipped about 1% right at the bell.
Which makes sense. A top line miss, that's usually the first thing algorithms and traders latch onto.
It is, but what's so fascinating is how fast that narrative just crumbled. The stock didn't just recover. It powered through and closed the day up 1.7%.
On volume, that was nearly double the day before.
Right. So that tells you the smart money looked right past that revenue number and dove straight into the quality of the earnings.
And management really set that tone, didn't they? The CEO, Raj Singh, he basically started the call with a mic drop.
He did. It was earnings are up, ROA is up, ROE is up, margins up, expenses are controlled.
And credit is flat. He laid out the whole profitability playbook in about 10 seconds.
It was a very conscious way of saying, look, we know we sacrificed some short-term loan volume, and that's intentional. We're focused on internal execution right now.
So it's a quality over quantity story. And in this rate environment, that quality story always comes down to margin.
Which is where this gets really good. Let's drill down into that core metric that drove all the confidence, net interest margin or NIM.
They hit their big 3.0% target a full quarter ahead of schedule.
A full quarter early. That was up 7 basis points from Q2.
Yeah.
But, the really telling part was the CEO immediately saying that 3% is just a way stop.
Right, not the final destination. He was signaling there's more room to run.
Exactly.
And you have to understand, this wasn't just them getting lucky with Fed moves. They were very clear this was all about operational execution.
100%.
Yeah.
It was driven by deliberate changes to the balance sheet mix. Let's look at the levers they pulled.
Okay.
First, they got the average cost of their interest-bearing deposits down by 8 basis points to 3.4%.
And at the same time, their total interest-bearing liabilities dropped by over $500 million.
By $526 million, yeah. But the big flashy move, the one everyone noticed, was paying off that high-cost debt.
The $400 million in senior debt that was yielding over 5%.
5.12% to be exact.
Mm-hmm.
So think about that. You're getting rid of debt that costs you over 5% and funding your operations with deposits that cost you 3.4%.
That spread goes straight to the bottom line. It's a pure mechanical improvement.
And it's sticky. That's why the market loved it. It's not a temporary win.
So looking ahead, what kind of REIT environment are they planning for?
Their framework is assuming 2 more Fed cuts in 2025, one in October, and then they're putting about a 75% probability on another one in December.
Okay, so with that in mind, what's the guidance for Q4 margin?
They're guiding to flattish. Basically, they're saying they've locked in the 3% level, and now it's about stability. They don't want to overpromise and underdeliver.
Smart. So that's the funding side. But the market also needed to hear about risk. What was the story on credit quality?
The term they used was very, very flat. And in this environment, flat is a huge win.
For sure.
Provision for credit losses was just $11.6 million. And the key ratio, the allowance for credit losses to total loans, held steady at 93 basis points.
That consistency is what you want to see. Now, what about non-performing loans, the NPLs? We know where the trouble spots are in the industry.
And they're not immune. NPLs were basically flat at $136 million. And yeah, they confirm most of that. About $119 million is in office in New York rent-regulated multifamily.
The two usual suspects.
The two usual suspects. But they gave important context on the charge-offs. They took $14.7 million in net charge-offs.
Which sounds a bit high.
It does, but they called it an idiosyncratic cleanup.
An idiosyncratic cleanup, meaning?
Meaning it wasn't a broad portfolio problem. They said it was mostly tied to just two specific loans, one CNI and one office loan, that are now largely reserved for.
So they're clearing the decks, taking their medicine now to set up for future growth.
That's the narrative, and it's a believable one.
Okay. And another area of concern for some banks has been this NDFI exposure, non-deposit funding institutions. Analysts push them on this.
And they gave new disclosures, which was smart. It helps build confidence. Total exposure there is $1.3 billion.
Which sounds like a big number, but what is that as a percentage of the total portfolio?
That's the key. It's only about 5%. And they were very careful to break down what's in that portfolio.
Right.
They said the biggest pieces are B2B credit and subscription lines, and they stressed that it's predominantly investment-grade secured lending.
So they're drawing a clear line saying this is not the risky private credit stuff you're worried about elsewhere.
Exactly. And to prove the point, they said only one NDFI loan, a $26 million one tied to office assets, was on non-accrual. It really calmed a lot of nerves.
It seems like it. Okay,
Yeah.
Shifting to capital. I mean, sitting on a fortress balance sheet.
They really are. Common Equity Tier 1, the CET1 ratio, is at 12.5%. And tangible book value per share is up at $39.27.
So with all that capital, what's the plan for the $100 million buyback authorization?
The key word here is opportunistic. That's what they want you to hear.
So not the slow and steady every single day kind of buyback.
No, they're explicitly moving away from that. They're signaling that when the market gives them a discount, like it did on the morning of this call, they're going to lean in hard.
Which is exactly what you want them to do when the stock is trading below tangible book. It's shareholder friendly.
For sure. And this focus on profitability, it isn't just about managing debt. It's about finding new ways to make money.
Right. Let's talk about that strategic growth, starting with fee income.
This is a huge piece of the puzzle for their future. If you strip out the runoff from their lease financing business, non-interest income is up 24% year over year.
And they said this is just the early innings.
The very early innings. They're building a much more diverse business model that's less tied to the whims of the rate cycle.
And the drivers here are all these sticky, commercial-focused businesses, lending fees, syndication fees.
Where they're now leading more deals, not just participating.
Right. Plus derivatives, commercial cards, and even a new foreign exchange business. They're trying to capture more of their clients' wallets.
It's the right move. Now, on loan growth itself, the headline guidance is for total loans to be flat year over year.
Because of that disciplined runoff we talked about?
Right. But under the hood, they expect core CNI lending to actually grow in the low single digits. And they said the Q4 pipeline looks strong.
And they're planting seeds for that growth in new markets too, right? Like Tampa, Atlanta, Texas.
Yep, they're investing where the growth is. But the best line about this whole transition came from the COO, Tom Cornish.
What'd he say?
He said that the big CNI runoff, the painful part, is in the bottom of the ninth inning.
The bottom of the ninth. I love that analogy.
It's perfect, isn't it? It signals that the cleanup is almost done and the path is being cleared for real organic growth to start picking up in 2026.
They're telling the market, we took the pain, we cleaned up the books, now get ready for the next phase.
It's a profitability first playbook, plain and simple. It's a game of inches, but all those inches are compounding.
Okay, that's a fantastic breakdown. Before we wrap, it's time for our segment where we cook up an outrageous but plausible trade idea.
And we have to say it.
We have to say it. This is purely for analysis and entertainment. It is not financial advice. Please consult your own professional advisor.
All right, disclaimer done. Let's look at the setup. BankUnited is trading around $37.46. Its tangible book value is $39.27.
So it's trading at a discount of roughly 6% to what the bank is tangibly worth.
Exactly. And we know capital is strong, CET1 is 12.5%, and management just told us explicitly that their buyback strategy is now opportunistic.
The table is set. The thesis then is that the market just hasn't caught up yet.
Right. The market has not fully priced in that new 3% NIM floor, the fact that the runoff is in the bottom of the ninth, and what that means for ROE in 2026.
So the discount to book value shouldn't last.
It shouldn't. Therefore, the outrageous but plausible trade is a leveraged long position. using out-of-the-money call options.
Okay, options. And you're targeting a specific price.
The target is a quick move up to $42 a share. That's tangible book value plus a small deserved premium. And the time frame is within the next 6 months.
42 is aggressive. What's the catalyst that gets you there so fast, especially with options?
The catalyst is twofold. First, the Q4 earnings call has to prove that 3% NIM is durable. That's table stakes.
And the second part?
The second and more powerful catalyst is management making good on their promise. They need to launch an accelerated opportunistic buyback campaign while the stock is still cheap.
So if they see that 6% discount and pounce like they said they would,
They will force the stock to converge with its tangible book value. And if that happens, those out-of-the-money calls could pay off very, very nicely.
it's a trade built entirely on management doing exactly what they just said they're going to do.
Pretty much.
Okay, to recap, BKU used smart liability management to hit its 3% NEM target early. Credit is stable, and they're signaling a major growth inflection point is just around the corner once this bottom of the ninth inning runoff is complete.
It was a masterclass in focusing on quality over quantity, and the stock's reversal that day shows the market gets it. And, the final provocative thought I'd leave you with is this.
Go on.
With the CFO transition done, with this game of inches approach clearly working, just how much higher will their return on equity climb before this stock finally sheds that regional bank discount for good?
A question we're thinking about as we watch for those Q4 results. Thank you for joining us for this deep dive. We hope this was a shortcut to getting smart on BankUnited's quarter. Until next time, keep exploring.